Imagine this. You finally moved to Italy. You're enjoying the dolce vita, but then a letter of the Italian residency, the Italian tax authority, lands in your mailbox, asking for more than what you expected. Did you miss anything? Are you paying more than what you should in Italy, or worse, are you breaking rules without knowing that? There are some mistakes you can fix right away, and you're in time. Let's start with misunderstanding the tax residency rules. Let's pick John, okay, a UK citizen who moves to Italy in April 2024 and he rents an apartment, long lease. He spends more than 200 days in our country and he assumes he doesn't owe taxes in Italy because he's still employed by a US company with a UK payroll and he pays taxes there. What's the mistake? John believes he is exempt from the Italian taxes because he's not fully settled in Italy, but spending more than 103 days in our country, it definitely meets the criteria for Italian tax residency. And this means that his worldwide income, no matter where, is subject to the Italian taxation, even if the salary comes from the UK. How to fix that? Well, if John has consulted with a tax advisor before moving, he could have taken advantage, for example, of the Italian regime impatriati. And this regime allows new residents to pay taxes just on a reduced basis, just 50% for the first 5 years. So filing for this regime within the first year of residency would have saved him thousands of euros. Many expats, they think they only pay taxes in the country where their employer is based. In reality, Italian tax residency rules give priority or where you physically live and spend your time. Another thing you can fix right away is not declaring foreign assets. Let's pick Sofia, an American living in Milan, and she has a bank account in the US with 100,000 sitting on that. She doesn't report it on the Italian tax return because she believes it's unrelated to her tax life in Italy. Well, a quick reminder, Italy requires residents to declare all foreign financial assets worth more than 15,000 in the RW form for wealth tax purposes. Failing to do so leads to penalties starting from 3% to 15% of the undeclared amount, with fines and penalties for the late filing. Sofia, in this case, should have reported her account in the RW framework of the Italian tax return. If she already missed the deadline, she can use a ravvedimento operoso, a voluntary disclosure program to minimize penalties. But still, many think that because their assets are in a different country, they're not subject to Italian regulation. Please don't think like that. The following is pretty common as well: mismanaging passive income. Let's pick Carlos. He is a Spanish guy. He rents a property in Madrid while living in Rome. He assumes that since the property is in Spain, he only needs to pay taxes there. What's the mistake here? Our rules require residents to report global income, remember, including rental and passive income from foreign properties. Carlo should have declared his income in Italy and offset any taxes paid in Spain through the foreign tax credit. By failing to do so, he risks double taxation and, why not, penalties for non-compliance. Carlo, or Carlos if you want, needs to file an amended tax return now and declare his Spanish rental income. Then he can claim a foreign tax credit for taxes paid in Spain, ensuring he's not taxed twice. But of course, how to do so? Well, more likely consulting with international tax advisors. In this case, many expats still assume that passive income earned abroad is taxed only in the country of origin. It's not like that. What about freelance income? A lot of people ignore the VAT on freelance income. Let's pick Anna, a freelance from Australia. She moves to Florence and she keeps on working with international clients. She doesn't register for the partita IVA, the Italian VAT business registration number, thinking it's not necessary since her clients are abroad and she got paid into the foreign bank account. Freelancers, business owners here in Italy must register for partita IVA if their yearly basis annual income exceeds a certain amount, let's say 5,000, even if their clients are foreign. Not doing so expose, in this case, Anna to back taxes, fines, and interest charges. How to fix that? Well, Anna right away should register for the partita IVA or consider joining, for example, the flat rate tax regime, the regime forfettario, where you pay just an alternative tax of 15% or 5% for the first 5 years. And then, following from that, she must go with the proper invoicing, electronic invoice, and record keeping to stay compliant. It's a very common myth that freelancers can operate without an Italian VAT number, business registration, if their clients are outside of Italy. And this false belief always leads to costly mistakes and people in a rush to fix that. Still, in 2025, a lot of people get wrong information or apply wrong rules regarding the tax-free income. Let's meet Michael, okay? A German retiree, and he receives a tax-free pension in Germany. And after moving to Tuscany, he assumes the pension remains tax-free in Italy based on his guts. Yes, Italy has treaties with many countries, but these treaties often agree that pensions are taxable in Italy if you are a resident. In this case, Michael's failure to declare his pension could lead back taxes and fines. How to fix that? Michael should review the dual taxation treaty between Germany and Italy first, and by declaring his pension, he ensures compliance and avoid penalties. And if this pension qualifies for tax relief under the Italian rules, then this benefit can be applied during the filing. Many people retiring from work think their pensions remain tax-free based on, I don't know, when they relocate. So, what's the common takeout here? Always make sure that you understand the basics before moving. Never trust what the logic suggests, and always remember that Italy may have crazy rules. But if there is something to be fixed, you're still in time to take care of that.